Hello and welcome to the second video lecture, Chapter 5, which covers the balance sheet and statement of cash flows. In this video lecture, we'll talk about the statement of cash flows. The first part of this, we talked mainly about the balance sheet, components of the balance sheet. And so now we're moving on to statement of cash flows, and we'll quickly talk about this supplemental disclosure and techniques to disclosure. So let's go to the slide 21. The statement of cash flows. So a couple key takeaways about what the statement. You've probably seen the statement of cash flows a little bit in your intro classes. What we want to do in this part of the chapter is we want to talk about why would we look at the statement of cash flows? Why look at operating cash flows instead of earnings? We'll talk about that a little bit. We'll talk about the different types of cash flows. You need to be able to differentiate operating cash flows versus the investing cash flows versus the financing cash flows. And then finally, we want to be able to calculate a basic statement of cash flows. So we'll do an example of that in this video lecture, and we'll do several of them in class on Thursday. All right, so the purpose of the statement of cash flows as our first, why do we care about operating cash flows? Why do we care about the statement of cash flows? Well, the statement of cash flows allows investors to know what's happening with cash, which is the company's most liquid resource. Again, just like the balance sheet, we're trying to evaluate liquidity, solvency, and financial flexibility. In this case, the way we're addressing that with liquidity, right, how quickly do we turn our assets into cash? How quickly can we turn our assets into cash? We're actually looking at cash to evaluate liquidity. With solvency, we want to know if there's cash available to pay our bills and where that cash is coming from. So statement of cash flow is really important to identify where cash is coming from. Where does the cash come from during the period? So that's really, I think, the main benefit of the statement of cash flows over the balance sheet is that we can identify where cash came from during the period. And that allows us to assess liquidity, solvency, and financial flexibility. So one of the main reasons that we want to look at cash from operating activities rather than net income is that you may have net income and be and no cash available. Cash is very important. We have to collect if we have accounts receivable. If we do a terrible job of collecting our accounts receivable, we might have a lot of income but not very much cash. And that cash is necessary for paying bills, for if we have loans, paying our debt holders, and so it's important to think about that. Trends over time. Are we doing a better job of collecting accounts receivable? Are we doing a better job of raising money over time? A lot of tech firms, a lot of new companies don't generate a lot of cash from their operations, so they might be generating that cash from investors, from getting loans, or from some other source. And so are they transitioning from being funded by loans and by investors, transitioning toward being funded, generating cash from their operations? And that's something you can kind of watch in the statement of cash flows. It's more difficult to see from the balance sheet. So another thing that the statement of cash flows does is you can figure out how much cash what cash was used for during the period. So you can look at are we investing our cash in new capital? Are we using all our cash in our operating activities? I think that's important, right? And then finally, of course, you see the change in cash balance. So again, that you might be able to see that from the balance sheet, looking at last year's balance sheet and this year's balance sheet. But we get a lot more detail about how cash changed during the period, and that can be valuable. All right, so that's the purpose of the statement of cash flows. As far as the format, there's 3 activities. You've probably seen this. There's an operating section, investing section, and financing section. Generally, the operating section has to do with business activities. It correlates really well to the income statement. It's cash flows related to the operating part of your income statement. Business activities how a business uses capital to create value. So it's their main line of business, operating cash flows. Investing cash flows, is kind of how your company invests capital. If I have, if I make loans or collect loans, if I buy investments or buy or sell PP&E, all those things are going to end up in investing cash flows. And finally, financing. This is how the business obtains cash or capital, cash from outsiders, cash that's not internally generated. How do they obtain this capital? They might have stock purchases. They might sell stock. They might have dividend payments. They might take out a loan or repay a loan. All these things would be listed under financing cash flows. So you generally think about your company. It's financed either via issuing stock or taking out loans, and expenses associated with those two activities would be listed under financing cash flows, financing activities. So how does that really kind of correlate to the balance sheet? So I think that's a good way to think about this if you're having trouble classifying items to the statement of cash flows. You can think about your balance sheet and think about sections of the balance sheet that correlate to the statement of cash flows. So operating activities, they're generally related to income statement items and changes in current assets and current liabilities on the balance sheet. So current assets minus current liabilities is usually called working capital. So talk about those as working capital accounts. Current assets and current liabilities are parts of your working capital. They're associated with your operating activities. Investing activities are generally changes in non-current assets on the balance sheet. So your non-current assets are your long-term investments, your PP&E, and intangibles. Those items are all investing activities. When you buy and sell those items, they're going to be recorded in investing activities. Financing activities are generally, long-term liabilities and equity on your balance sheet. So anything that affects long-term liabilities or equity on the balance sheet is generally going to be in the financing section of the statement of cash flows. So that's a general guideline. Of course, you need to know those definitions about what investing activities, financing activities, and operating activities are. And there's lots of examples in your text, and we'll go through a bunch of them in class on Thursday. But that's kind of what we're talking about with these three areas. As far as different types of preparation, how do you prepare a statement of cash flows? Well, with operating activities, what we're going to do is we're going to transform net income. We're going to start with net income, and we're going to transform it into cash flows from operations. And we'll get into what that means. That's going to be kind of the bulk of this part of the chapter, is figuring out cash flows from operations here. With investing and financing activities, all we're doing is identifying activities and changes in applicable balance sheet accounts. And the way we're going to use that, it's more about identification rather than a transformation. So we'll go through an example in just a second where we do this. A transformation, so this is the cash flows from operations. Again, this is the main part of the chapter. How do we create the cash? How do we create the operating section of the statement of cash flows? So how do we create the operating section of the statement of cash flows? Well, we're going to start with net income. Net income is based on earned revenues and incurred expenses. We're going to make a bunch of adjustments to it to get to cash flows from operating activities, which doesn't have basis in accrual basis of accounting. It's cash basis accounting. So we're going from accrual basis accounting to cash basis accounting, and we're going to make these adjustments to do that. Common adjustments to net income to get to cash. So net income, right? It's under accrual accounting. We want to get to cash flows from operations, which is a cash flow accounting. We're going to look at changes in current assets and current liabilities. We're going to make adjustments for changes in current assets and current liabilities. We're going to make adjustment for depreciation and amortization expense because these are non-cash expenses. So it's a big thing. If there's some kind of non-cash expense, we have to adjust net income for that. And then we're going to make adjustment for gain or loss on disposition of long-term assets, because those are actually investing cash flows rather than operating cash flows. So those are the three common adjustments to net income. Again, it's really related to our accrual accounting entries, our adjusting entries. We make adjusting entries for that go into current assets, like accounts receivable, current liabilities, like accounts payable. Those are generally, we'll make an adjusting entry for that. We're going to make an accrual for those. We're doing these things to make net income reflect accrual basis accounting. But then we have to back them out so that we can get back to cash flows from operations. Again, depreciation and amortization expense. Again, these are non-cash items. So we need to take them out of net income. And so we'll go through an example how to do that. So here's sort of a guideline for the adjustments we want to make to current assets and current liabilities. If we have a decrease in current assets in accounts receivable, inventory, or prepaid expenses, we're going to add that to net income. If we have an increase in those kinds of accounts, we deduct it from net income. If we have an increase in current liabilities, like accounts payable, accrued liabilities, or income taxes payable, we're going to add that to net income. If we have a decrease in current liabilities, we're going to deduct it from net income. So, with depreciation, amortization, depletion expense, they're expenses that do not involve cash flows. So again, we have to add those back. So we're going to eliminate the effect on the income statement of transactions that do not result in an increase or decrease in cash. So these items do not involve cash flows. We need to reverse them. Okay? With gains and losses, again, like we said, these are investing activities. We have to remove them from operating activities and put them in the investing section. So, if we have a sale of an investment, sale of PP&E, that's going to result in a gain or a loss in net income. But those are related to investing activities, not to operating activities. So gains and losses, that's the other type of big thing. So here's these other items. This is a nice little summary table. If we have depreciation expense, amortization expense, or depletion expense, we have to add it back to net income to get to operating cash flows. With losses, we have to add those back. With gains, we have to deduct them. So that's pretty helpful here to look at that. Here's our example. We can go through this brief exercise 512. Kieser Beverage Company reports the following items in the most recent year. They have net income of $40,000, dividends paid of $5,000, an increase in accounts receivable, an increase in accounts payable, purchase of equipment, depreciation expense, and an issue of notes payable. So this is about as hard a question as I'm going to ask you guys to do with the statement of cash flows in this chapter. When you get to intermediate 2, you're going to get more difficult. You're going to have a whole chapter dedicated to statement of cash flows, so it'll be harder. But for this class, we're just going to do a basic statement of cash flows based on some information here. All right, so the required number 1, we're going to compute the net cash provided by operating activities, and then we're going to compute net change in cash during the year, so the entire cash flow statement. So for number 1, we want to start with net income, and then we want to make these adjustments that we talked about. We want to adjust net income for items that do not affect operating cash flows, like depreciation expense and gains and losses on assets, sales. And we also want to make adjustments for increases and decreases in current assets, current accounts, current assets, and current liabilities. So those are our 2 things we're going to do. Let me get back to this. So we'll start with net income, which is $40,000. Dividends paid, that's going to be a financing cash flow that's associated with our financing activity. put that there. We have an increase in accounts receivable, an increase in accounts payable. We need to deal with those when coming up with operating cash flows from operations. We have a purchase of equipment, which is going to be an investing cash flow. So remember, it's those long-lived assets that are really related to investing cash flows. And depreciation expense, that we're going to deal with that, right? That's part of your income statement. We have to add that back to net income. There's an issue of notes payable. The issue of notes payable is going to be a financing cash flow. So this item, right, we're trying to fund our business by borrowing money. We can either borrow money by issuing notes payable, or we can raise money by issuing stock, and we have to pay dividends on that stock. So that's associated with financing. So I think we have the three items that we're going to adjust net income by: an increase in accounts receivable, an increase in accounts payable, and depreciation expense. So we'll start with our $40,000 net income. We're going to have an increase in accounts receivable, which we're going to subtract from our net income, because an increase in accounts receivable represents revenue that we recorded that's not associated with any cash. We have an increase in accounts payable, which we're going to add to net income, because the increase in accounts payable represents expenses that we didn't pay any cash for. And then we have depreciation expense, which is a non-cash expense that we need to add back. So it's an expense that we recorded but isn't associated with any cash. So our cash flows from operations are $41,000. And you can follow this through. The depreciation expense is added back, the increase in accounts payable is added back, and the increase in accounts receivable is deducted from net income to get to $41,000 of net cash provided by operating activities. Now, we also said that dividends paid and issue of notes payable were cash transactions that affected financing cash flows, and the purchase of equipment was a investing cash flow. So we can finish up our statement of cash flows. We got to this point by answering part one of that question. Our investing activities, we have the purchase of equipment of $8,000. Our financing activities, we have the issuance of note payable and dividends paid of so $15,000 net cash flows from financing activities. And then at the end, we have our net increase in cash of $48,000. Now, when you do a problem like this, you can always check with your balance sheet to make sure that your net increase in cash that you record on the statement of cash flows ties to the change in cash that is shown on the balance sheet. All right, so hopefully you guys can do a problem like that. There'll be lots of examples in the homework and in class on Thursday. The last part of this chapter is supplemental disclosures. There's sort of four types of information that also get disclosed associated with the balance sheet. We could have contingencies, which are, all these items we'll probably talk about in more detail as we get through this class this semester. But this sort of a primer on them. Contingencies, companies have contingencies for events with an uncertain outcome. So a lot of times, I think of contingencies, I think of legal contingencies. Companies have lawsuits, and they don't know what the outcome of the lawsuit is going to be. And so they have to make some sort of disclosure about those lawsuits that are out there. If you guys remember from chapter 1 and 2, we have this full and fair disclosure principle that we have to follow. And one of those is to disclose these contingencies, items that have an uncertain outcome. We're not sure if we need to put them on the balance sheet or not. We have a lawsuit, or there could be a very expensive lawsuit where we have to pay a lot of money out, but we don't know yet. So contingencies are disclosed. Accounting policies are disclosed. So if you use a valuation method like LIFO or FIFO, that stuff gets disclosed in the notes. depreciation methods get disclosed, investments in subsidiaries are disclosed. All this stuff has to be, so in order to really understand the numbers in the balance sheet, you need to be able to look into the notes and read about the accounting that produced those numbers. Contractual situations is the other one here. A lot of times companies, if they take on debt, you take a loan. So if you take a loan from the bank, part of that loan might say that you're restricted from doing certain activities. So the bank will give you the money as long as you don't invest really in really risky stocks and bonds. How about that? Something like that. These contractual situations could restrict your business from doing anything at once. And so the FASB says we need to disclose contractual situations that are tied to specific assets, or like most likely liabilities. So usually this is financial. These are called debt covenants that restrict companies from doing certain things as a condition of providing a loan to them. And then finally, fair values. Fair values, like we talked about a bunch of times, they come from lots of different places. It could be fair value might not be from a liquid market. It might be something where a company just sort of decides what the market value of their asset is, and that could be subjective. So the FASB says you need to disclose a lot of detail on where you got your fair value estimates from. So, and again, another thing we'll talk about in more detail when we get to the investments chapter. So I think those are the four kind of supplemental disclosures we talked about in the text, and that'll be it for this chapter that we're going to cover. So I think with that, we'll finish up this video lecture, and I'll see you on Thursday for our problems.